icebreaker questions, but I want us to get into the meat of the conversations. So with that, I'll just start with Nathan, no stranger to anybody in the room, but if you would, please introduce yourself and tell us who you're with.
Is this thing on? Hi, everybody. Good morning. I'm Nathan Donato Weinstein. I'm with the Office of Economic Development in the city of San Jose. We're the part of the city you want to call when you're interested in investing in San Jose or bringing in a new company. And I'm also working on our Opportunity Zone strategy. And I'm also on the board of Cruise Silicon Valley.
Great to have you, and I apologize. Feel free to introduce yourself and tell us a little bit about something you've been working on as it relates to OZs today.
Hi, I'm Emily Bias. I'm an attorney with Pillsbury, Winthrop, Shaw, Pittman, and I focus on tax-advantaged investment. So a lot of low-income housing tax credit work and reaching out into the Opportunity Zone program. I'm heading up a group within our firm to learn more and to see who we can help get into the program.
Great to have you. Chuck?
My name is Chuck Tang. I'm the founder and partner with Studio T-Square, with a multidisciplinary firm specialized in master planning, urban design, and architecture. We're happy to say, proud to say that we've actually been invested in Opportunity Zone 25 years ago in Oakland, San Jose, Long Beach, long before it became the kind of flavor of the day. Currently in San Jose, closer to home, we're currently under construction on a project named The Reserve with Greystar. We've been very proud to work with Republic Urban on the Tamian Station, along with CORE as well, affordable and a market rate project, a TOD project. Proud to be here, and hopefully I'm actually getting some questions answered as well as answering some questions today. Thanks.
Hi, I'm Erik Hayden. I'm the president of Urban Catalyst. We are a multi-asset real estate equity fund focused on ground-up development in opportunity zones. We're specifically looking at downtown San Jose and downtown Oakland, and I'm happy to be here today to talk about it.
Todd, I'll let you take it away.
Yeah. So another hot topic, opportunity zones. We're going to start very high level in our discussion, talk about the legislation, then we're going to dig into San Jose specifically and some of the things the city can do to help energize and stimulate these zones. So from a very high level, the Opportunity Zone program is about deferring capital gains. And in the United States today, there are an estimated 6 trillion unrealized capital gains sitting in investment accounts. So if you think about 5% of that money being realized and reinvested into these opportunity zones, that's $300 billion flowing into these opportunities. So that's why it's gaining a lot of attention, obviously. Platform Ventures, our firm, will be launching the fund in the second quarter, and I'm excited to dive into it here with the panelists because it's not only an opportunity, it's a bipartisanship legislation, which coming out of DC these days is very rare. So I think it's jazzing up a lot of folks. So Emily, why don't we start with you? If you could just give us a very high, an overview of the Opportunity Zone program and why the federal government created this plan, and why don't we start with that?
Absolutely. So the Opportunity Zone program was introduced as part of the 2017 Tax Cuts and Jobs Act. And the idea behind the program is to revitalize low-income areas where investment otherwise wouldn't be incentivized. The way the program works, as Todd said, is you take existing capital gains and invest them in opportunity zones, which are census tracts designated for inclusion in the program. How it works is an investor takes their existing capital gain and they invest it through what's called an opportunity fund. And that is an investment vehicle to invest in opportunity zone property or opportunity zone business property. And an opportunity zone has to invest 90% of its assets in the opportunity zone property. And that property can be anything. It can be infrastructure, real estate, stock in a startup business. There's a really wide range of investments that are permissible under the program, and only a few that are excluded, and I call those fun businesses: golf courses, bars, tanning salons, things like that. After the investment is made, so you take your capital gain and you have to reinvest it within 180 days of realizing it. Once it's reinvested, the tax that would otherwise be due on that gain is deferred into the earlier of 12/31/2026, or when you sell your investment. If you hold your investment for 5 years, you get a 10% step up in your basis, which means that when you ultimately pay the tax, it's reduced by 10%. If you keep it in the fund for 2 more years, for a total of 7, you get an additional 5% step up, so a total of 15% tax reduction. The biggest benefit is if you keep your new investment for 10 years, any gains you make on your new investment at the end of that 10-year period are completely tax-free. So I think that's where most of the excitement is after that 10-year period, you're looking at a completely tax-free gain. So I'll stop there, but if you have any questions, happy to talk afterwards.
Yeah, no, I mean, it's a good transition for Erik, actually. I mean, Urban Catalyst has their fund launched already, right? And investments being made in it. I mean, from your standpoint, what's the best benefit for investors coming into a qualified opportunity fund? And then also maybe talk a little bit about the structure of your fund, because there are different ways these funds are set up. They're set up potentially as single asset funds or multiple asset funds and as a portfolio. So maybe talk a little bit about the benefits of how you set up your fund. And
Sure. So Urban Catalyst, I mentioned earlier, we're a multi-asset fund, which means we are going to have a lot of different properties. We're anticipating through the duration of the fund that we'll have somewhere in the neighborhood of 30 to 40 properties. We're set up in a specific way to maximize the returns to our investors. And in order to do that, we will buy these really good projects, do ground-up development to meet all the opportunity zone requirements, and then at the end of 10 years, we'll liquidate all of our assets and provide a return of capital and profits to our investors tax-free. There are some opportunity funds out there that are set up that have more of a cash flow focus, where they are a tax deferral mechanism to do ground-up development, and then they just want a cash flow like maybe a more traditional REIT. We are more like a traditional real estate equity fund.
Okay. So before we jump into the local, Emily, just from a legal standpoint, as we have to always talk about disclosures, or at least my compliance department always makes me do this. Are there any risks that investors should be aware of before kind of jumping into a qualified opportunity fund?
I think the biggest thing to think about is investing in an opportunity zone does not make a bad project a good project. You need to do your homework. You need to do your due diligence, and you need to treat it like you would any other investment. Because, if you go out 10 years and you don't make a capital gain, maybe it wasn't the best investment. And if you're looking for cash flow during that time, you need to think about what you want out of your investment and whether that investment's going to get you that. The other thing, I think a lot of people are stressed out about the timing crunch. As I said, to get the full benefit of this program, you need to be invested for 7 years prior to the end of 2026. Guess what? That means you have to be invested by the end of this year. And as you probably know, there are still a ton of questions out there about how this program works. We got one round of proposed legislation in October. We're waiting for additional legislation, additional regulations. It's been delayed because of the shutdown. So there's a lot we don't know. And I think I would just caution investors against rushing in without really taking a look at the investment, just based on the time crunch. There's still plenty of incentives out there.
All right, so let's dive into San Jose a little bit. Nathan, over 6,000 businesses and 60,000 jobs located in the designated zones here in San Jose. So why is the city interested in this, and what's the city's role in stimulating additional growth in those zones? What's the goal?
Yeah, that's a great question. So we're super thrilled to have 11 opportunity zones that were designated in San Jose. And one reason why we think we're really well positioned for this is that we have so much diversity in terms of the opportunities that are in those zones. And so we know that there's going to be lots of different investors that have different types of investment theses, and we have the types of opportunities to really provide them with some great potential projects and investments. And these zones really line up well with our general plan and our goals to grow both housing and jobs. So San Jose has some pretty ambitious targets in its general plan to increase employment and housing for people along the entire income spectrum. And so, we're super thrilled that downtown has so much growth capacity in it, but we're also really excited that the Monterey Corridor area has a ton of really great, viable industrial product that can support quality living wage jobs. So there's a lot of alignment in terms of our city priorities.
So Erik, I mean, your office is in an opportunity zone here in San Jose. You guys are focused in San Jose, and what excites you about the zones from an investment standpoint downtown?
Well, first of all, listening to the mayor this morning, it really reminded me of just how awesome a place San Jose is to do business. I mean, not all mayors talk like that. They don't all say, we want to get shovels in the ground, we want to streamline fees. So from a city government standpoint, San Jose is a fantastic place to do business. Secondarily, as far as economics and the job engine of Silicon Valley, the mayor mentioned that another opportunity fund thinks that San Jose is the third best area, the third best opportunity zone in the nation. We really think it's the best. I mean, that's no joke. The infrastructure that's in place in Silicon Valley and in San Jose and the Silicon Valley job engine, they make San Jose the best and really the prime place to do development. But taking a step back, I've spent most of my career doing development in the San Jose area, and we've really built a team that is focused on the downtown San Jose opportunity zones. And with our team, we're really hoping to activate the downtown. Over the 10 to 14 year period that our fund will be active, we're raising $250 million, and with leverage, that could be $1 billion worth of impact into the downtown San Jose area. We're hoping that 10 years from now, you see crowds on the streets. You see that we've built a lot of office to bring jobs to downtown. You see we've built a lot of residential to help solve the housing crisis. And really just made it a great place to live.
So, check. We talked a little bit about, I guess, some of the code changes potentially, adding some density. I heard lower fees. I don't know if everyone else heard that. But can you explain? There are time constraints tied to the investment of opportunity zone locations, and to make it qualify as a good investment within the Qualified Opportunity Fund. But you kind of pair that up with the current entitlement process and the strains on that system today. I mean, can you maybe provide some suggestions on how we can streamline entitlements so that there's not as much of that timing crunch to meet the investment timelines?
First of all, I'm really excited about how the city of San Jose's land use kind of effort overlay into the ozone. And I think one of the opportunity is how we leverage kind of the local land uses already in place and how it would fold into the ozone. I think there's a huge opportunity there. Whether we take advantage of it from each city's point of view, that's a different question. I think just in general, for entitlement process, approval process, it's really about certainty. The good news is that with this program, there needs to be a window, right? We need to meet a deadline. The bad news from an entitlement process point of view is there's not a real clarity in how that process will work. So I think for all of us in this room, certainty is probably the most important thing. Certainty in timing, certainty in the processes, and certainty of the delivery, especially given the construction costs right now. So specifically to San Jose, the process has been kind of preliminary submittal, and then PD zoning, PD permit, so the sequence, and then also fold into that CEQA. So all of that kind of puts into a time constraint, right, or a lack of time constraint. So how do we fold that process, maybe concurrently a PD zoning, PD permit together, or expedited CEQA process? All of those things are really important given that we have, 8 months to qualify a project. And the other questions I have is, what constitute a kind of a complete application so that you can move these funds forward? Is it basically a application? Is it a PD zoning level kind of review? Maybe avoiding the CEQA as the initial engagement? All of those things kind of goes into the timing and the execution of these funds. So interested in hear what Nathan has to say as well.
Yeah, thank you. So I think what I would say is our expectation is that there's going to be a lot of interest from investors in finding those projects that are sort of already along to some extent in the process. So we actually have quite a few entitled projects that are sort of sitting on the shelf and looking for investment partners that we can, one of the things we're doing is getting these inquiries from investors that are saying, what are the opportunities in San Jose, and we'll kind of play a little bit of a connector role in that, to that extent. The other piece of advice I would give is, keep in mind that in our growth areas in San Jose, a couple of which are in our opportunity zones, but also citywide, we have some program level EIRs that have already done a lot of the CEQA work for you. And that's, of course, where projects can run into issues with timing. And so, for instance, in downtown, we have a program level EIR that clears a ton of capacity for commercial and residential. And so, faux pas. In downtown, you can do a project pretty fast. You can get your PD permit in 90 days to 6 months. If you kind of stay within the framework you've laid out.
Just keeping it with you for one moment, the mayor talked a little bit about some of the zones and the diversity in those zones across San Jose. We've got, from the airport to downtown to East San Jose. From your standpoint, what makes those viable areas of investment, and what type of investment does the city want to see in some of those? So it's a long question because there's a lot of zones to talk to, but maybe if you could expand on that. No, I mean, please take your time.
Yeah,
it's important. I mean, I think it's an important question to understand.
Right.
As we think about each zone, what we want to focus on from this.
I think it's clear that the zones are not created equal, right? So downtown has all this growth capacity in it, and I think that's where you're seeing a lot of the buzz, which is great. The North San Jose Opportunity Zone is also going to be a huge play for housing once that ability to do more housing is brought back online, which will be soon. But remember, there's a broader opportunity here, and opportunity zones were kind of sold to the public as this ability to also bring new jobs to underserved communities. And so it's not all about real estate. The real estate aspect is awesome, but as we heard, this is also a way to invest in operating businesses. We have a really big interest in that because for a company that's looking to start up or relocate, this could be a really big site selection factor for them because it gives them access to a new kind of capital. And so we're interested in that for a number of reasons. We're interested in that for small business. We're interested in that for industrial employers that can help revitalize our business corridors and bring in new types of jobs. Just think about all these really cool startups that are doing amazing stuff in the construction space, like Katera that's out in the East Bay with a modular housing factory. If they can locate in an opportunity zone, they can have access to a new source of capital. That could be a huge deal. So I think every business needs to be asking itself, should I be in an opportunity zone?
So, Chuck, do you think, we talked a little bit about the local programs and impacts, but you think about programs like the Grand Boulevard Initiative, which was regional in terms of activating a certain corridor and working side by side in regional, with the regional agencies. Do you think the Opportunity Zone investments are going to be more localized in their benefit, or do you see regional, more regional coordinated growth initiatives around certain corridors?
I think it's a great opportunity to think regionally, given the opportunity. I just learned something from Nate last night that the basis of the ozone right now is the general plan. But I think given the governor's challenge to all of us to deliver the needed housing, that I would implore all the cities that we're talking to kind of look at maybe the broader aspect of opportunity of what this ozone can do to the local land uses. So that's one thing that I would promote. I think For us, I think the main thing is really understanding the clarity of a kind of a development area. So, for example, for us, the most successful projects are like the Grand Boulevard, or each city has a specific plan or a precise plan. By right, you can go and build something to a certain area, to a certain height, certain bulks, or a certain FAR. That is what I would love to see in the O zone, so that we understand the uses that would go into each zone, the amount of capacity, and by right, what the developer can build. And I think that would help all of us to be able to exercise all these funds that Erik has and everyone else in the room has in a very efficient way. But the problem that we have is, if we were to go through a specific plan, precise plan, engagement, 3-4 years, you're almost half the window into this fund. So those are the challenges that I think we need to work out. So.
I mean, Erik, do you guys have active investments right now in the zones that you're making on behalf of your fund? Are there?
Yes, no, absolutely we do. We have one project that we've announced, which is in downtown San Jose, where the Lido building is on South First Street. We're going to be building a 60,000 square foot office with around 15,000 square feet of retail. We have another 4 projects right behind that, all in the downtown San Jose Opportunity Zone, either in the downtown area or near Dearborn. But I wanted to go back to something that Emily said earlier about sort of the biggest risk in opportunity funds in general. And really that is, you need to have projects that work. A lot of people out there are thinking that these opportunity zones are going to increase land value. I'm going to come in as a joint venture equity provider or preferred equity provider, and I'm going to be able to give you better rates than other groups out there. When in reality, we're competing with other real estate equity funds that raise their money from pension plans and endowment funds that are, those are tax-free entities. So we really have to have projects that work, and we really do. And I'm glad you asked about our first projects. Our first projects are pretty awesome, at least in our opinion. And we're putting them together. Traditionally in the past, our team of developers, we've gone out and done project-specific financing for every single project. But when we saw opportunity zones come along and these opportunity funds, we saw this as our way of creating these projects in the same manner, but also giving our investors the tax breaks of the opportunity zone legislation. So overall, it's a win-win. But you definitely have to have projects that work and great projects in your pipeline.
You alluded, just kind of expanding on what you were talking about in terms of tax-free investors and then the opportunity zone potential investors. Can you talk about the return differences or the mechanics of a traditional private equity fund that might be backed by a pension fund or tax-exempt entity versus a qualified opportunity fund, and how that might differ?
Sure. Overall, at least our structure, we are almost identical to a traditional real estate equity fund focused on ground-up development. Some of the major differences that we have, of course, is we have to comply as a qualified opportunity zone every 6 months. And one of the ways, with the current interpretations from the IRS and the legislation, one of the ways that we're able to, after 10 years, give the profits to investors tax-free is we're structured as a private REIT. And as a private REIT, we also have to qualify as a REIT every quarter, and we have to distribute 90% of our taxable income to our investors. Now, all these compliance issues, they are a real thing, so we've hired what I consider a team of the best consultants, attorneys, accountants, financial compliance officers in the country to work with us to make sure that we dot every I and cross every T.
Okay. Let's see. So, Emily, we talked a little bit about, before this, we talked about affordable housing, talking a lot about opportunity zones. Your practice has been, focused on tax advantage investing as well as affordable housing. Do you see avenues where affordable housing investors might benefit from the opportunity zone legislation and how that might work side by side?
It's a really interesting question, and we're trying to figure out how to make it work. Under the current federal statute, there's no incentive to restrict rent and income. You don't get bonus points or additional tax advantages if you do a low-income project. And it makes sense that low-income projects aren't generating as much revenue, as much capital gains, so they're not attractive to investors. That issue has been discussed in front of the IRS in their hearings last week, It's been suggested that when regulations are issued, that there are some restrictions that make affordable investing more attractive, but I don't necessarily think that's going to be included. So I think the answer is we have to look to the local governments to layer on additional restrictions or advantages to incentivize the investing. San Jose has inclusionary housing. A ton of localities have inclusionary housing, or in their general plans, things that touch on the requirements of affordable housing. But we could also do, perhaps offer property tax exemptions for projects that are affordable, or just other ways that could reduce operating expenses and try to offset the decreased revenues that the projects are going to receive. Also, in the panel before, we talked about a lot of the projects are restricted for 55 years. Perhaps we, in certain programs, can shorten the term of the restrictions, so when your 10-year holding period burns off, maybe the restrictions burn off, and you can sell the project, realize a gain, and sell it for a little bit more than it was originally worth. So I think those are things we can explore, but there's a lot of work to do to figure out how to include affordable housing in these zones.
Can I ask Emily another question? So one of our dreams in San Jose is that this could generate interest from philanthropic or impact investors or CDFIs who are working with capital that has a different type of outlook on the investment, that might be interested in doing deals that do well while doing good. So, maybe it's a market rate residential project that also has below market space for small businesses, or a commercial kitchen project that does market rate leases while also offering some kind of special incentive for local food entrepreneurs or something like that. In your practice, do you see interest from those types of investors, or is it more of kind of your traditional, for-profit type of groups?
Well, I think that's where it gets a little bit difficult. So my practice is mostly affordable housing, and the investors in those deals are usually using the low-income housing tax credit. And they're not looking for projects that are going to make profit. They're in there for the tax credits, and they've got their own reasons for investing. Opportunity zone investing is different, and those typical investors that you see in affordable projects, they aren't the right investors for these projects. So yes, I think it's, it just has to be structured correctly, and maybe it's a mixed use project where 4 of the 5 components are financed by opportunity zone investors, and there's a real profitability there, and maybe one component can be in a below market rate component, and maybe it wouldn't otherwise get built without the other 4 components. So I think as a part of a bigger project, that's definitely something that could happen.
All right. So we're going to play devil's advocate a little bit here, just because I'm the moderator and I get to ask the tough questions that are loaded. So we talked about economic revitalization in certain areas. Downtown San Jose, there's a lot going on right now, a lot of development, a lot of capital coming in here. It's a very hot market. So this is a question maybe for Nathan or Erik. Do you think downtown San Jose should be designated an opportunity zone?
So we've gotten that question, and it's a totally fair question. So, there is a lot of momentum downtown, and, the question's been asked, like, hey, is this really an area that deserves this designation? And my answer is 100% yes. So, first of all, it qualifies, right? And secondly, we have a lot of awesome stuff happening downtown. But downtown still struggles in a lot of ways, and we, talk very openly about the lack of foot traffic on some of our key commercial corridors, and the struggles that small businesses have in kind of making it work. And, the need we have is for more bodies and more activation. We've got, plenty of buildings where you have boarded up storefronts. All of that is the reality right now. And so while there's been a lot of investment, and a lot of potential future growth, we also have 3,400 housing units that are approved and not moving forward because, I think there's a lot of reasons, but, costs are high, and other factors as well. Anything that kind of could help us bring more people to downtown, I think is a good thing. And that will help drive the whole economic ecosystem and help keep those small businesses going on the ground floor, and that benefits everyone in the community.
Anything to?
I mean, San Jose in the last 60 years has come a long, long way, and it still has a ways to go. So I think that I echo Nathan, 100% it should be included in the Opportunity Zone, and it was included in the Opportunity Zone, and so here we are.
All right, so Chuck, I asked Leslie and Catherine earlier sort of the biggest challenges that they saw facing affordable housing. So in the perfect world, what barriers they would like to see broken down. From your standpoint as an architect, urban planner, what's the biggest challenge you see or barrier that you see in the way of the opportunity zones really accomplishing what they're trying to accomplish in terms of revitalization?
Yeah, I think housing is kind of our core competency, and housing is very finite. You can dissect it into a lot of segments. And I think one segment that when we talk about affordable housing, one kind of subcategory is homeless, the sheltering the homeless. I think that's one thing that I see is really, we're passionate about working on a project called Evans Lane here in San Jose. We're the architect for it. But I think is an issue and a problem that we all have to solve together. To me, you almost have to start from the grassroots. And I think the opportunity zone, especially the light industrial area, could actually create some opportunity for these kind of transitional housing or permanent housing even. But it might require more tax credits or from the city, local government, or even from the state. That to me is a part of the issues that we have to address, not only in San Jose, all over California. So I think I want to make a plug for that. And then the other thing is also kind of how do we create more workforce housing, not just market rate, but there are segments of different housing types. So the co-housing, the idea, all these innovative ideas, we need to start looking at our code, our zoning, to really kind of spread it out a little bit more and not to be too dogmatic about the definition. So.
Nathan, similar question for you, maybe breaking down challenges. I don't know if it's working with private sector or what it is, but from the city's standpoint, what would be the perfect world in terms of the funding behind some of the initiatives that the city's trying to accomplish from the private sector, maybe working with the private sector?
Right, okay, so no fees, 100% affordable housing.
I heard that.
Okay.
No fees.
And market rate housing. So what are we doing to help facilitate investment that aligns with our priorities? I think it's important to recognize the city technically doesn't have a role in Section 1400-SC, right? The Opportunity Zone statute. And so we're that said, we do think we have an important role to play in our community because we know these zones. We know the communities that are in them and kind of what their needs are and who those community leaders are. And so part of what we're doing is holding convenings. We held a workshop about a week and a half ago with over 100 investors, including CDFIs and philanthropic investors, to kind of educate them on, hey, here's what these zones are, here's what the community needs are, right? Because these are opportunity zones because low-income people live in them, and it's important to keep that in mind. And here's our guidance for you on how to work through the city process and meet your timelines. So we're going to help where we can, right? And we're going to provide that due diligence assistance, but we're also going to provide that matchmaking function. We've been working on sort of a package, an info packet to educate investors, including out-of-town investors, on, well, hey, what are these zones all about? What is the city's vision and priorities? So that they can understand, what can they do here?
So we talked a little bit about local, we've talked a little bit about regional. Just going to take a step back for 1 minute. We've talked about the opportunity zones providing deferred tax benefits. There are other ways to invest in real estate to defer taxes, not necessarily revitalizing environments like the opportunity zones goal is, but there is the 1031 program and some other tax efficient ways of investing in real estate. So Erik, maybe for you, question is, can you talk about pros and cons of the Opportunity Zone program versus a 1031 investor, and outside of, I mean, obviously there's the social impact of it, but maybe
Sure. I mean,
comparing the two.
we talk a lot about this with our potential investors because most of our investors that have a capital gains event, a lot of times they also have real estate and they kind of want to know the difference. Now, of course, the 1031 exchange program has been around for 25 years, and it is the tried and true method to defer capital gains really forever through buying a larger property. And when I say that, for example, a 1031 would be you buy a building for $5 million. 5 years later it's worth $10 million. Great project. You're going to sell that building. You're going to buy another building for $10 million or more. Also, just kind of high level, to do a 1031 exchange from the date of the sale of your property, which is your capital gains event, you have 45 days to identify 3 properties, and you have 180 days to close on one of those 3 properties. And of course, closing on real estate is not a simple process. So I guess what I'm saying is those types of gains is very narrow in the overall capital gains pie. Opportunity zones allow you to invest capital gains from the sale of stock and bonds, the sale of businesses, really any type of capital gains. For what it is, a 1031 exchange for real estate is still a better option. More than likely, most of you will choose to do it because it is a better option. You can defer your gains forever. But for everyone else that has capital gains events that don't specifically fit into that small slice, opportunity zones are going to be the new 1031. 3 or 4 years from now when it's all cleared up and everything is said and done, everybody's going to be talking about not, am I going to invest in an opportunity fund? It's going to be, which opportunity fund am I investing in? There's also a couple subtle differences to point out. The first is when you do a 1031, your initial investment plus all the profits you made in that building, they all have to roll together. In an opportunity zone, you get to take your basis back. So if you invested $5 million in stock and you have $10 million now, you get that $5 million back in your pocket. You only have to roll your profits into the opportunity fund. The second, interesting component, and we find this in a lot of our investors, is when you're in a partnership and you own property and you want to sell it, to do a 1031 exchange, all of the partners have to roll together into the new property. And a lot of times, for whatever reason, one of the partners wants to cash out, or maybe the partners don't want to be partners anymore. And we find that, as an opportunity fund, we're a very simple solution. You don't have to close escrow on a property and identify it. You read our private placement memorandum, sign our subscription agreement, and wire money into our account. And we have the same 180-day timeline from the capital gains event, and I don't think that's any coincidence. So we're a very simple option if your 1031 isn't going to work out for you, or if you're choosing, to separate a partnership.
I'm going to have one more question here, Chuck, for you. We've talked a little bit about, a lot of capital potentially going into these zones. I think I mentioned earlier, 5% of the unrealized gains in America today would result in about $300 billion of new cash or new investment coming into a limited area of these zones. So just in perspective, from a private equity standpoint, the dry powder sitting on the sidelines last year was about $200 billion, maybe $250 billion. So we're potentially doubling the investment opportunities in some of this. Are you, as you're putting together, working with groups like Urban Catalyst, and are you seeing land values starting to move and impacting potentially the need to change land uses around to make it work? I mean, we talked a little bit about adding density and things like that, maybe to buffer that. But are you starting to see movement?
Yeah, definitely. I think there's 2 categories. With developers, there's obviously a shift from kind of more market rate. The bigger entitlement projects, I think, is a little bit further apart. So there's definitely kind of a flow of dollars into senior and student housing, other types of housing. But I think for us, I think one of the challenges really kind of how do you balance the two, right? We need the housing, but at the same time, we need to generate some flow of business. So what are those things that could still maintain the supply of housing, but while the equity sources are changing? So, and then also the other categories, we're dealing with advising a lot of landowners, and all the landowners, they have expectations that's now dated back to 2016, 2015. So they're constantly looking for added value to the land. So when they look at the general plan, they say, great, it's general plan. Why don't we put a state density bonus on top of that? And then in addition to whatever leverage we have to upzone the land. So that's consistently the things that we're hearing as we're advising landowners. And some of these landowners, we survey the site that we're working on, half of our site is in opportunity zone. And so they're asking all these questions. How do I upzone the site? Right now the general plan is too low. So there's still that, even though the equity might not be coming in, but the expectation from the landowner is still very high within these zones. So how do we balance that?
The answer is just work with the city of San Jose, I think. Right?
One thing I wanted to add on to Czech's comments about, is land being priced up in opportunity zones? We think because of this, influx of capital really funneling money into these lower income areas, there are going to be a lot of funds that are set up and a lot of people really focused on these specific areas, and hopefully that'll bring up land values and make more development happen. For right now, it hasn't happened yet. We were one of the first multi-asset funds to get set up in the country. When we started, there were 10 funds open nationwide. Now there's closer to 150, but in California, there's still just a handful. And we're really one of the only groups that's focused on downtown San Jose, and our business plan is to go and find all the best properties now before all the prices get bid up through the opportunity zones in the future.
Erik, why are there only 3 in California? Why are there only a few in California?
It's really because a lot of the financial markets nationwide are just focused in New York and Boston and Philadelphia. It's, finance and the East Coast kind of go hand in hand. I assume there's going to be quite a few more, but we'll never have the same density of opportunity zones as the East Coast does.
All right, so I think we have to wrap it up here, but want to open it up to some questions in the crowd. So maybe a couple questions if there are any. Yes.
Great. I'm Fran Doherty, Quain Financial. I had a question related to the 1031 exchanges and ozone, or ozone. So you mentioned how with ozone that any kind of capital gain, stocks, business, and the like. Is this being seen by investors as a potential mechanism to get those kind of gains into a real estate project and then being able to continue rolling them into a 1031 exchange? Say, like, if they sell the property before 10 years and do have a capital gain still?
I don't know if I necessarily understand your question. You're talking about the profits from the opportunity fund after 10 years?
So say they don't hold the
think
asset in the ozone for the full 10 years, they don't have the full forgiveness of that gain. Is that a way for them, that gain, to be rolled over to a new real estate project and continue to defer it then in the future?
There's 2 separate plans there, I think. The first is the 1031 exchange. You have to keep that exchange alive. A 1031 exchange, you cannot exchange out of a qualified opportunity fund into a 1031 exchange, most likely. They're limited partnerships or something like that, and so they don't have to qualify for a 1031 exchange, have to have an ownership in that entity that owns the property. Here, the Qualified Opportunity Fund owns the entity that owns the property, so you're a step away from that. So it's going to disqualify your 1031. You can't 1031 out of a QOF. But what you can do is, if the QOF sells, you can roll into another QOF, a Qualified Opportunity Fund, and keep that deferral going. Now you'll lose the stepped up basis potentially depending on how long you own it, but that gain that's earned in the Qualified Opportunity Fund over that 10-year period is still relevant and still available, I believe. So they're 2 separate issues there.
That's if the investment would have to be made before 2026 though. So if you hold it for 10
Correct.
years, you would be timed out. So as the statute reads today, I don't think you could hold it for 10 years and then reinvest it and have it qualify.
Right.
I think there's discussion though to extend the timeline.
We have another question back here. Hold on.
What triggers the investment? Is it your investment into the fund or the fund's investment when they start taking the hole in the ground? Does construction have to start before the end of the year to qualify?
So I guess I'll take this one. So there are 2 separate timelines. The first timeline, these are, to qualify as an opportunity fund. The first is within 31 months of money coming into my fund, I have to deploy that money into projects. And our business plan to do that is to do all of our first projects in all cash so we can deploy the whole $250 million right away. and then we can refinance and redeploy as we have new projects. The second timeline that we're up against is you have 30 months from the day you purchase the land to substantially improve the property. And substantially improve is defined as putting money into a project on a one-to-one basis equal to the value of the structures that are built on the land, not including the value of the land itself. And you can determine the land value through an appraisal.
I think the other part of the question was, if they invest in your fund, does that start the 10-year trigger, or is it when the fund actually makes the investment in the land? It's into the fund, I believe.
Yeah, we're looking at it as into the fund, that's correct.
Yes.
So one question, how flexible is the boundary of the opportunity zone? Is there a possibility of altering if there is project right?
It's not flexible at all, and that's frustrating. It's frustrating, right? I mean, we totally get it. These are the census tracts. You know, we saw this up close when so it's the state who is the ultimate decider, and the state decision process was really just not. It was a couple of weeks, right? A couple of months, a couple of weeks. And, you know, there was really only, I think, one round of sort of revise, 1 or 2 rounds of revise. Emily, do you remember?
I don't know exactly,
Yeah.
but I agree with your
And
conclusion.
that
It's
was
not
it.
flexible.
And then afterwards we got inquiries like, oh, wait, can we add another ozone? And, you know, under the framework as it exists now, no. Although there has been legislation to add census tracts in the case of natural disasters and something else. Does anybody remember? There was like another kind of thing. So, you know, could there be another round is anyone's guess. That there was some talk of that early in the process, but we haven't heard that. And I think just given the way Congress is right now, I'm not expecting any movement there. It would literally take an act of Congress.
All right, well, I think that's all the time we have, so thank you everyone up on the panel for your insights.